John, these are tough times in the market. The economy, domestic, internationally, politically. We went from the everything is great, everything bubble to now there doesn't seem like a good, safe place to put money. Even the best of the worst ideas, you lose to inflation. So what do investors do? How do we respond to this?
Well, the problem that most investors have is they get in this binary conversation that's been basically taught to them by a generation, 2 generations now, of stockbrokers and investment advisors. Your choices are stocks and bonds. And, are you bullish or bearish? Well, you got to ride out the bumps, all of that nonsense. You have lots of choices besides index funds and stocks and bonds. By the way, this is the first recession, bear market crisis, whatever you want to call it, that bonds have gone down at the same time that stocks have. I mean, there's been no place to hide. Normally you roll into bonds and they increase in value and you've got some protection. And that's why the kind of 60-40 bond split that came in, it was just a volatility kicker. That doesn't happen today. Today, though, there are lots of opportunities in the private market. There's lots of, even if you don't have that $1 million to get into the private market, there's ways that you can invest for credit, smaller deals that'll give you 4 or 5% in the public markets, especially today. The private credit markets, you can get 8, 9, 10% on reasonable risk to reward deals. There are tons of real estate options and funds that you can. Private funds, the public funds have problems and have volatility issues. But I'm a big real estate fund. I'm a believer in high and growing dividend stocks. Companies that grow their dividend every year for the last 20 years are probably going to continue to grow their dividend. They've got a pattern. You can sit and watch the underlying numbers. There are people that do that for you for not very much money, so you can do that. I'm a big fan of doing what I call 80-20 investing, where 80% of your money is your core. And you invest it to get 5%. And so you're going to grow it back to your original number plus a little extra, your 100%, within 4 to 5 years. And then 20% is your explorer bucket. And you divide that up into, 7, 10, and you're taking a little bit more aggressive shots. There are, we have in my firm, we have opportunities. Each firm has its own set of networked opportunities, some better than others. But there's a lot of opportunities to 2, 3, 4, 10 times your money. Now, you don't want to put all your money on those things. You get, 2% of your portfolio here, 2% there. But you can get a nice portfolio of potential high flyers. But you have to be careful. You assemble it over a period of 2 or 3 years. You don't have to do it in 2 months.
Right.
And there's things, but there are things that investors can do besides index funds.
You were the one who taught me. You said, friends don't let friends buy index funds. Can you explain that?
Yeah, that's true. Buy and hold. By the way, I have funds, managers that we invest in that trade index funds. Index funds are the old joke. These are trading sardines. These are not, you don't eat these sardines, you trade these. And that's what ETFs are. ETFs are very, very good trading vehicles. And you can, with momentum or whatever strategy you're going to use, you'll underperform the market on the way up, but you're going to do considerably better on the way down. And your balance over time should give you an outperformance. There's, if you have access to them, there's all sorts of trading strategies, hedge funds. There's a lot of things people can do that don't look like traditional stock and bond investing.